Everyone is telling you something different right now. Investing. Buy gold. Save 15% for retirement. Avoid tech stocks because an AI bubble is coming. Don't trust the market. Trust the market. Wait. Act now. And if you're a beginner, all of this noise creates one result: paralysis. So the real question isn't what headline is right. The real question is, what should you actually do in 2026 if you want to protect your money and grow it long term? In this video, I'm going to walk you through a clear, simple, beginner-friendly framework. No confusing jargon, no hype, no guessing. And I strongly recommend that you stay until the very end, because the final step is the one most people skip, and it's the difference between people who plan to invest and people who actually build wealth over time. I spent years working in banking, analyzing how money moves, how people invest, and most importantly, why most people never feel financially secure even when they earn more. And here's the truth most financial content doesn't tell you. People don't lose money because they're bad at math. They lose money because they don't have a system. They react instead of plan. They guess instead of structure. They follow headlines instead of principles. So today, I'm going to share 6 essential things every beginner must understand and apply before investing in 2026 based on long-term financial principles that actually work. These are not tricks. These are foundations. Step 1. What investing really is and why it matters. Let's start with the most basic question, because if you get this wrong, everything else falls apart. What is investing? At its core, investing simply means using your money to make more money. That's it. Not trading all day, not predicting markets, not chasing trends. Just putting your money into assets that grow over time. So why does this matter so much? Because of inflation. Inflation quietly erodes the value of your cash every single year. Prices go up, rent goes up, food goes up, services go up, but the money sitting still in your bank account does not. So if you have $1,000 today and inflation averages just a few percent per year, that same $1,000 will buy significantly less in 5 or 10 years. Doing nothing feels safe, but in reality, doing nothing is a slow and invisible way to lose purchasing power. The second reason investing matters is even more important. In today's economy, owning assets is rewarded far more than earning a salary. People who own businesses, stocks, real estate, or other productive assets benefit from growth. People who rely only on income often feel stuck in a loop: earn, spend, repeat. If you've ever felt like no matter how hard you work, you're always just trying to keep up, this is why. If you want to stop feeling behind, investing is not optional anymore. It's essential. Step 2. Clarity before action, the step most people skip. Once per year, you should take a full snapshot of your financial life. Ask yourself 3 simple questions. How much did I earn this year? How much did I spend? Did I end the year with a surplus or a deficit? This sounds basic, but most people never actually do it. And here's a powerful mindset shift that changes everything. Treat saving and investing as spending. Why? Because when you do that, any money left over at the end of the year is truly unused potential, money that could have been working harder for you. This step helps you identify patterns you didn't know existed: emotional spending, seasonal expenses, subscriptions you forgot about, small leaks that quietly add up. Awareness always comes before growth. If you don't know where your money is going, no investment strategy will save you. Step 3. Build a solid financial foundation. First, an emergency fund. You should have enough easily accessible cash to cover 3 to 6 months of essential expenses. And this is not a one-time decision. If your life changes, higher rent, new responsibilities, family, different income, your emergency fund needs to change too. Next, balance cash and investments. Too much cash loses value to inflation. Too much invested money can force you to sell at the worst possible time. Here's a simple guideline. Money you don't need within the next 5 years should generally be invested. Money you might need sooner should stay liquid. This balance protects you while still allowing growth. Step 4. Stop trying to pick winners. This is where many beginners overcomplicate things. They think they need to predict the next big company, the next breakthrough stock, the next trend. But even the biggest companies can fall out of favor. History is full of examples. That's why many successful long-term investors use index funds. This reduces risk, it removes guesswork, and it allows you to benefit from long-term economic growth. And diversification doesn't stop at companies. Global diversification matters too. No one knows which country or industry will dominate the next decade. Owning a little of everything is often smarter than chasing whatever is popular today. Step 5. Automation, the most underrated wealth tool. This is one of the most powerful strategies, and most people completely ignore it. Automation. Instead of trying to time the market, invest a fixed amount every single month. This approach is called dollar-cost averaging. Some months you buy when prices are high. Other months you buy when prices are low. Over time, it balances out. And more importantly, it removes emotion from the process. Automation protects you from panic selling, from fear, from headlines, from procrastination. Your biggest risk is not the market. It's your reaction to the market. Step 6. Systems beat goals. This is where everything comes together. Goals without systems don't work. You need structure. Set up automatic transfers for savings, investments, retirement contributions. Pay yourself first before you see what's left. Reduce friction. Keep emergency funds separate. Unsubscribe from impulse buy emails. Make investing easy and visible. Create a simple dashboard, spreadsheet, app, or notes to track progress. When progress is visible, motivation follows. The goal isn't to think about money all the time. The goal is to set it up once so it works quietly in the background. Final thought. If you only take one thing from this video, let it be this. Wealth isn't built by guessing. It's built by systems, consistency, and patience. Now, tell me in the comments, which of these 6 steps do you need to work on the most? If this video helped you, like it, share it with someone starting their investing journey, and check the next video where we break down the biggest beginner mistakes to avoid in 2026.